Hello everyone, and welcome to this quick presentation of how to work out the risk of investing abroad using a two-asset portfolio. Okay, so we have here investor Adrian, and he's thinking of investing $3 million in the United States, which will pay him a 6% interest rate in 12 months' time, and simultaneously, he is also thinking of investing 5 million euros in France, which will pay him 4%. So what we have here with the countries you can invest in, France and the United States, we have the estimated exchange rate, also known as the forward rate in 1 year. We have the standard deviation, and with the correlation of the two currencies. So let's have a look at the first question. It says, calculate the British pound value of the expected return of the two foreign investments. Okay, so we're going to do here, we're going to get a table. A4. And type in return investment. So Adrian is going to invest 3 million States dollars. He's also going to invest 5 million euros. His return is going to be, so what we want to do now is we want to take the return times we want to take the investment times the 6%. So we say 3 million times 1.06, which is the same as saying 3 million times 6 divided by 100. So that's going to give us a return of $3,180,000. And we do the same for the euros. We say 5 million times 1.04 equals to 5,200,000 euros. Okay. Now the question also asks us to convert this into the pound value in 1 year. So in 1 year, Adrian will expect to have, so what we do is we convert the 3 million into pounds using this exchange rate. So we say this times this, which gives us 1,621,800,000 pounds. We did the same for the euro. We say 5,200,000 euros times 0.71, which gives us 3,692,000 pounds. So we have a total return of 5,330,800,000 pounds. Now, the last thing we need to calculate is the weighting, which will go into the portfolio. So we want to see how they're weighted at, weighting in percent. So what we do is we say, we take this figure and we divide it by the total, which gives us a weighting of 30.52%. And then we say this figure divided by that total, which gives us a weighting of 69.48%. Of course, if you know the weighting of one figure, you know the other, because you'll just say 100 minus 30.52 will give you this. So that's a total of 100%. Alright, so that's the first question done. The second question says calculate the expected standard deviation. So all we want to do now is we want to have a look at the risk. How risky is it to invest abroad with these two investments in my portfolio? So we use this standard formula here. It might look a bit complicated, but it's actually quite easy. So what we do is, that's some, I can use you later. So we say the square root of the weighting, 0.31, we get the weighting from here, just rounded it off, 0.31 to the power of 2 times standard deviation, which is given to us here, 0.1 to the power of 2 plus the other assets in the portfolio, which in our case is the euro, the investment in France. So we have a weighting of 0.69 0.69 to the power of 2 times the standard deviation in France is 6%, 0.06 to the power of 2, and finally we say plus times this formula. All it's saying is that 2 times the correlation times the weighting and times the standard deviation and times the correlation. So it'll look like this. So we say 2 times the correlation is 0.58 times, and then the easy way to remember is just say 2 times the correlation times that. So it looks like 0.31 times 0.1 times 0.69 times 0.06, right? And that'll give us 6.45%. So what we have here is with the square root, we're using this formula with the square root. I'll just go through once more. With the square root of, that's the weighting, which we get from here, to the power of 2, using the formula, times 0.1, the standard deviation, which we get from here, to the power of 2, plus 0.69, again the weighting of the euros, times the standard deviation, which is 6%, plus 2 times the correlation, that's what we get from here, just show you that, correlation, the dollar. So all this is saying is that 2 times the correlation times that and times that. So 0.31 times 2, get that from here, and 0.69 times 0.06, that's the same as this one, just without the power of 2, and that's going to give us a risk of 6.45%. So that's the volatility of our portfolio if Adrian wishes to invest in these two markets. He should expect a risk of a volatility of 6.45%. Alright, and that's it. Thank you very much.